Hi, good evening everyone. My name is Kate Almond. Today I'm very excited to present you the third part of this lecture in risk management. And today we're going to be discussing macroeconomics, and we'll be giving you an introductory lecture on macroeconomics and how they should influence your investing. Obviously, none of this should be considered financial advice. Before making any important financial decisions, always consult a financial advisor. Thank you, Benjamin Cohen. It's one of the best finance channels on all of YouTube. And so I want to discuss what we talked about in episode 1 of risk management in this series, which we went over opportunity cost, what it means to be diversified and how important it is to be diversified, and the advantages of the S&P 500. Some of these advantages of the S&P 500 is that the U.S. controls over 60% of the world's best colleges and schools. This means that the U.S. has a highly educated and very, very intelligent population that really is able to drive a lot of innovation in the world. We have the largest military, so we're able to protect our interests. The U.S., compared to a lot of areas in the world, really does a really good job at handling inflation and having low unemployment. Additionally, the U.S. leads in AI, computer hardware, finance, medicine, energy, and software, which helps the U.S. grow. And lastly, the U.S. tends to outgrow most of the economies in the world, despite being the world's largest economy. So this might not make sense, but typically the smaller a country is, it should be easier for it to grow. It's kind of like a snowball. A small snowball doesn't need a lot of snow to double its size, right? If you have a big snowball, to double its size, to grow bigger, you need to add a lot more snow, and you need to spend a lot more time adding more to it. So that's kind of a really important fact and consideration. And usually for these reasons, a lot of people, especially for beginners, are told to invest in the S&P 500. Moving forward, in part 2, I try to make you a more sophisticated investor by trying to understand important concepts of stocks. For example, we discussed how when you lose money in the stock market, it can cause really bad issues. So if you lost 15% of your money in the stock market, it might take you 1 year to recover. Or if you lost nearly half of your money, if you switched out to a different stock, the average stock would take you 5 years to just break even, just to make yourself whole again and repair all the losses at a 45% loss. At an 85% loss, it takes a decade and a half to repair all the damages from those losses if you switched into a basic, your basic average stock. And we can see these different financial instruments, such as bonds, they usually drop 0%. Gold usually drops 15 to 20%. The S&P 500 drops 20 to 45%. Tech stocks can drop 45 to 75%. And crypto can easily drop 60 to 85%, even more than that. So you should really be considerate and have an understanding of how bad it can be to invest in a particular asset. We discussed the word drawdown, which is formally the percentage drop, the largest percentage drop that an asset has had, given in some window of time. So for the S&P 500, for the past 20 years, the largest drawdown it had, which is the percentage drop, was in 2008, where it dropped from around $1,600 to basically 70. And this was basically a 57% drop in the S&P 500. So we would call that the max drawdown is 57% in financial terms. We discussed the risk and return ratio. I don't want to go into that too much, but basically we got an understanding that if we look at the ups and downs of a stock, we can compute a scoring system, but usually to get a more accurate scoring system, we look at the losses of a stock, so how much the stock loses, and the fluctuations of those losses, the standard deviation. We divide the standard deviation on the average returns, and then we are able to compute a score, basically, compute a score. And the score is telling us how much risk we're taking on for the return that the stock gives us. So we can see in this example, this stock gives us 19% returns on average. However, the risk that we're taking on, which is the standard deviation of the negative price drops, is 11.5. This gives us a score of 1.65. And when we compare it with this stock, we can see that this stock up here is more desirable to invest in given these factors. So finally, moving on to the topic of this lecture, let's discuss macroeconomics, which is the different internal forces which help shape the economy and thus kind of influence investing behavior. And the topics that we're going to discuss today are interest rates, unemployment, and inflation. These might sound pretty basic, but I think once we get a better understanding, you'll see probably how you might want to modify your investing behaviors given these variables. So we'll get started with the first topic, which is interest rates. And for those of you who are unaware of interest rates basically is kind of the mechanism where if people don't have money right away, but they want to make a big purchase, what they'll do is they'll borrow money. They'll borrow a large amount of money. And the lower the interest rate is, it makes borrowing that money much easier. But if you have a high interest rate, well, basically borrowing that money is going to come with a cost. You basically pay a fee every single year. And the higher the interest rate is, the higher the fees are for you to borrow that money. So this is pretty important because, a lot of important financial decisions, for example, cars. A lot of people are not going to buy cars because, the average car, I think, is $26,000 in today's market. A lot of people don't have $26,000 to put down right away. So they'll borrow that money and they pay a fee for borrowing that money. But the important thing is to understand is if interest rates are high, that means you're getting punished extra. You're paying larger fees. So because you have to pay larger fees, it limits your ability to buy cars, right? So what I'm trying to tell you is that with higher interest rates, people don't typically buy because they don't want to be punished with high fees. So with lower interest rates, you'll see people usually buy cars. You'll usually see people buy houses. They'll wait for low interest rates to buy houses. Another important thing is school. Oh, this fella might be recognizable. But a lot of people, don't have enough money to afford their own school and will have to take out student loans. And if interest rates are high, the loans tend to be more punishing. So interest rates have a pretty important factor to people graduating and going through college. Well, last but not least, bonds. So bonds are essentially these contracts that you sign with the government, and the government assures you that they'll pay you a set amount of money every single month. They'll pay you out monthly. If you give them, let's say $10,000, right? You give them $10,000, they'll pay you back, let's for say example, $50 every single month for 2 years. At the end of that contract, at the end of this bond, the government will return all the money you gave to them. So it's nice because, if you give the government $10,000, well, you get that $10,000 back, but the government was giving you money for 2 years, right? They're giving you $50. Nice thing is with bonds is usually there's very little risk. All the money you put into it, you'll get back over some period of time. But when interest rates are higher, the government will give you more money to try to incentivize you to buy bonds from them. And so, just to recap, low interest rates usually allow people to buy cars easier, allow people to buy houses easier. It's easier for people to go into university. And low interest rates actually disincentivize buying bonds. And so we can start to see how this might influence the economy or investing. But I wanted to actually show a really interesting piece of research that I've kind of came across, which is the we're going to discuss the Harvard Happiness Study. And for those of you who are unaware, the Harvard Happiness Study is over 80 years. And this particular study is the largest study ever done on human happiness ever done. And a lot of the studies that were done, they're not done with surveys, but they're done with blood tests. They're done with brain scans. They had a little bit more testing involved. But it's the most thorough and largest testing ever done. And one of the outcomes that's really interesting in this study is that what they conclude is that a lot of happiness does not come down to cholesterol levels or blood pressure at age 50, which they thought would be important. Those factors are not important. It was satisfaction in people's relationships, particularly in their marriage, that was the best predictor of a happy and healthy life. So one of the findings is that people's relationships, and this is from the Harvard website, the Harvard Gazette, marriage is one of the most important contributing factors to people's happiness. This is what the most studied and longest survey of human happiness has said, at one of the best institutions in the U.S. And a lot of people, you're watching a video on macroeconomics, and I just started talking to you about the human happiness survey. And what you must be thinking in your mind is, well, I don't really understand what this has to do with anything. And the point I'm going to get to right now, and by the way, there's an interesting graph over here which shows happiness by religious affiliation, and you can see a little LDS religion tends to score one of the happiest religious denominations. You have the number one being Baptist, the second one being Evangelicals, the third one's being the LDS, the Latter-day Saints. Now, what's really interesting is the Latter-day Saints have one of the highest marriage rates by their religious affiliation. So it's funny that you see this kind of play out in statistics as well. But anyways, going back to what I was going to say, marriage is one of the most important factors to someone's well-being. And if you look at divorce rates compared with interest rates, we see something interesting. So you can see the blue one being the divorce rate and the red one being the interest rate. And you can pretty clearly see how these are connected in a pretty devious way. It's pretty depressing if you think about this. So when you have high interest rates, it literally destroys some of the happiest things that human beings even have, which is being married, right? When interest rates go up, you can see divorce into almost the 50 range, it's just horrible. Like, high interest rates are terrible. You don't see people buying houses, you don't see people buying cars, and you don't really see people going to college. But even on top of that, even if you were able to get those things, those assets at low interest rates, the thing that's most important to your happiness is most likely to be destroyed because of interest rates. And it's a really peculiar, kind of depressing graph that I wanted to show. And this is really why interest rates are so important, just from this graph alone. So that's why you should care about interest rates, and that it should actually influence you should really factor it into your decision making when investing. Obviously not financial advice. And so just really briefly, there's a SoFi article. SoFi is a new bank, and in this article it has some key points, and it says that the interest rates affect interest rates influence stock markets by influencing borrow costs for consumers and corporations, which can impact public companies' earnings and stock prices. Higher interest rates increase borrowing costs, thus potentially slowing the economy and reducing stock prices. Next point. Lower interest rates can boost stock markets by making borrowing cheaper, encouraging spending, and increasing company revenues. So, from this article by SoFi, very clearly lays out the point that high interest rates usually are not good for stocks and usually slow the economy and reduce stock prices, while low interest rates tend to make the economy better. It's tends to grow assets more. So low interest rates means higher stock prices, less divorce, more home and car buying, which means people progress through life. And so a really important question you should be asking yourself, but think about it. Well, interest rates are so important. Why don't we permanently keep interest rates at zero? Right? Why don't we just permanently make interest rates low, right? If raising interest rates is worse for stock prices, more divorce, you have less home buying and car buying, what's even the point of ever raising them? Why wouldn't you just keep them low forever? Which is a question you should be asking yourself. Okay. I guess I didn't make a slide for this, which I apologize for. But let's quickly look at interest rates, and let's look at the S&P 500. You can see the S&P 500 is the blue line, while interest rates are the orange line. You can clearly see in this area, interest rates are falling, are being cut. The S&P 500 is clearly growing. However, as soon as you saw interest rates rising over here, you saw the S&P 500 do nothing for several months as interest rates were going back up. And you can clearly see over here, once interest rates, literally on the day that interest rates started to be reintroduced, started to be raised, you clearly saw the stock market drop. And in this recent week, interest rates were hiked up, and you saw an immediate loss, immediate sell-off in the S&P 500. To explain this behavior, people get scared of the economy when interest rates go up. But I also mentioned bonds, right? Bonds are really good when interest rates go up. Therefore, people will take their money out of stocks knowing it's going to be more risky, and will literally put that money into a less risky asset that they're guaranteed more money on. So this is why you typically see sell-offs during rapid increases in the interest rates. So that's an important understanding. And let's go back to this question, is why we can't always have low interest rates. And just like I discussed, the lower interest rates are, the more people can buy cars. Meaning, if you have many people competing to buy cars, you get increased demand, which usually increases inflation. Because if you have many people who can go and buy things, that usually raises the price of things. The more money people are able to access, the more spending they do, the more prices of everything go up. The more housing goes up, the more cars go up. Because many people are now trying to buy. So, with low interest rates, it's not a golden bullet, as you might think. I discussed that there's many advantages, but actually just keeping them too low really hurts the economy as well, because eventually inflation's going to start coming up, And actually, now things become more unaffordable, right? So at that point where prices rise, things are becoming unaffordable. So then interest rates aren't even helping at that point anymore. They're not really increasing economic activity. So there's sort of a sweet spot with interest rates, because obviously you don't want to have so many people buying that you just raise the price of everything and now everything's expensive again. So there's kind of a sweet zone you want to be in with interest rates, and that's why they fluctuate so much. And obviously we know why we can't have low interest rates, but with high interest rates, obviously you get more divorces, you have less people buying, therefore you have companies which start to hurt. So now we'll discuss unemployment and what happens when companies start to hurt. So obviously unemployment is just how many people do not currently hold a job in the U.S. economy. And we'll give an example of what unemployment really starts to do to an economy, and you can consider this graph. So you can see this person, for example, right here. He works for McDonald's, as shown by this arrow, and he buys at this shop Diamond Cookies. He's a regular customer there, as denoted by this line. This guy works at Duck Duck Car Wash, and he's a customer at Google. This guy works at Google because of this line, and he buys at Duck Duck Car Wash. This guy works at Cash Jewelers, this guy right here, and he buys at YouTube. So that's essentially what this graph is showing. Now, with this graph, let's assume in this, fictional scenario, a new wheat disease has evolved into the world. This wheat disease spoils the milk of cows, which eat the contaminated wheat. Well, in this scenario where we have a new disease, we can clearly see that Diamond ice cream now has a problem. All the milk they use for their ice cream is kind of being contaminated. There's a supply issue. And let's say this guy who works at McDonald's, the employee at McDonald's, who usually buys food from Diamond ice cream, is no longer able to afford it because Diamond ice cream had to raise their prices. By raising their prices because of this event, they lost a customer who was the person who worked at McDonald's. And because they lost their customers, well, they're put in a really bad situation. Their company is basically on fire right now. And eventually, this guy right here gets unemployed. He's now unemployed, and his company just went under. His company's destroyed. Diamond ice cream is done for. But now we can see at Cash Jewelers, it doesn't have any customers anymore because it just lost its only customer, which was from Diamond ice cream. So it no longer has any customers, which means it puts this business on fire and cannot support the job for this guy right here. Which means this guy now no longer has the money to invest into YouTube. So then YouTube lost its customer base and is forced to lay off this guy because it has no money. Which means McDonald's no longer has customers coming in because its customers just lost their jobs. And that company's on fire too. And so on and so forth, right? And then you now have Duck Duck Car Wash. Sorry. I think I messed up this graph. But at the end of the day, you can now see we only had two companies that were able to survive, which is Google and Duck Duck Car Wash. While all these other companies went under because of this really, really, really crazy scenario. Most of these companies just went under. And now you have these people who have important things that they need the money for. They need to keep up with their car payments, their housing payments, insurance, all these things, food. Yeah, they're put in a pretty tough spot. because of this scenario. And that's how you can see unemployment, the larger it gets, the more scary it is, especially for an economy. We have tons of people who are no longer able to participate anymore. These people will shut down other companies by not spending, by not having money to spend. And then that army of the unemployed grows. So it's really important. I would argue unemployment is the single most important factor when looking at recessions. And should also be something that you consider when investing. And, unemployment can really spiral out of control this way. So you just saw how, a small increase in unemployment can have drastic impacts on the entire economy. And for you to really understand unemployment, you should also understand the concept of initial claims. And initial claims is just people who file for unemployment benefits for the very first time. And if we look at the S&P 500 with unemployment being the green line, you can see pretty clearly that sometimes when unemployment really starts to rise, the S&P 500 just drops. You're going to see in these purple boxes, you have these pretty brutal crashes every single time you saw unemployment go up. In my personal opinion, you have initial claims down here. Initial claims are the blue one. The S&P 500 is the orange lines. And in my opinion, this 3,000 to 300,000, 350 to 300,000 line, this purple box, that's where initial claims need to be in order for you to even have a recession. So we can see initial claims are pretty low right now. So it's unlikely that we're in a recession right now. But if you ever see initial claims start to go into this $300,000 figure, I would start to be very worried. I think that's the number one factor to really being worried about a recession. And you can kind of see during the early 2000s, you can really see we got above this line for long periods of time, and we didn't durably break below these lines, the $300,000 purple box. And you can see the S&P 500 literally did not grow since 2000 to 2012. And you only saw the S&P 500 really going crazy, in my opinion, because initial claims have always been low. Like, look how low these have been. I mean, literally, look. You saw, 20 years where initial claims are pretty high. Once they went low, I mean, the S&P 500 has just taken off. And it's really because, in my opinion, because of initial claims being low. Initial claims being the amount of people who are filing for unemployment benefits for the first time. And so that right there was unemployment. The last thing we're going to talk about is we're going to touch base on inflation. So one way we saw inflation occur is when people were able to buy things at a really rapid pace. When people can just buy things, borrow money very easily without having any punishment, they'll buy so many resources that these resources become scarce. Therefore, the prices rise, which is considered inflation. Inflation is the rise of the price of goods. But we can also see inflation rise when we have oil. This is because, things like cars, houses, all these important things, they're just a combination of other inputs. And these inputs need to be, traveled. They need to commute together. They need to be built together. And usually, the component that really facilitates all this transportation of these parts together is oil. The fusing of these things together, the energy that society runs on is built on oil. So when you see the price of oil go up, you pretty clearly see inflation go up. And you can just see that this is the blue line is oil. The orange line right here is inflation. The orange line is inflation, the blue one is oil. If you look right here, you can see oil went up high, and inflation followed a month later, just a few weeks later, and also hit a high. I mean, you can just see I mean, they just follow almost identically. Like, these almost follow completely identically, oil and inflation. And you can just see this graph, and it's pretty self-explanatory. But a really interesting thing that you should also know is how important inflation oil can be. So if you ask ChatGPT or an AI, I asked it, can you give me the dates of when oil spiked over 30%? It gave me some of these dates. And I want to look at what happened to the stock market in these dates to see really if oil had an impact. We can see during the early 2000s, you saw the S&P 500 drop, I think 57% right here. And it started actually late 2001, right? Oil was going up or late 1999 to late 2000. So you can really see oil didn't immediately shut down the economy, but down the road it caused problems, and the S&P 500 gave up and collapsed. And this is the early 2000s right there. This one. We go to 2007 to 2008. This should be pretty obvious. But yeah, we see 2008, 2009. But oil, remember, if you go back, oil was rising in 2007, middle 2007 to late 2008. 2007 was right around here in the middle of it. So you can see, sure, oil didn't immediately crash the stock market, but it was pretty close to a year afterwards. It just gave up. And if we go back, so that was 2008, but if you look at 2011, this is 2011, where the S&P 500 did nothing. 2011 right here. A year later, the S&P 500 collapsed again. It wasn't as bad as 2008, but I mean, that was pretty close to a 20% drop, I think. So we just looked at 2000, we just looked at 2007, and we just looked at, 2012. And then lastly, if we look at 2020, you can see for the whole year we went down. And then this is also 1991. So you can see in every single one, we went back to, I think over here, every single time we look back, oil went over 30%. Every single time there was usually a recession around a year later. Every single time, without exception. And that's really why, oil is a pretty important input into the economy. And if you just look recently, I mean, you can see oil 2006, right? Oil's been going up, and therefore you've been seeing inflation go up as well. Yeah, so I know I just talked about a lot of these concepts, and I can't make this video too long, but in the next episode I really hope to take you to a more advanced level for macroeconomics. But with this knowledge, you now know how interest rates affect the economy and how it impacts marriage rates. And you know why we can't keep interest rates too low. We discussed unemployment and how unemployment can start to spiral out of control if nothing's done about it. We discussed inflation and how low interest rates can create inflation, and how oil can also help create inflation as well. And in the next episode, I really want to discuss how you can build a pretty creative model and formula that can really help you kind of make smarter, more sophisticated investing choices. And so, yeah, that's all I had to discuss for today's video. I hope you found that very informative, and you look forward to the next episode. I know I do. And with that being said, thank you so much for watching, and have a wonderful rest of your day. Thank you so much.